Well, Indian investors have been having not a tryst, but a very deep romance with equity markets for the last 24 months. We thought the SIP culture is ingrained. Month after month, we saw higher and higher flows into equities. So this sudden jolt to this relationship that has come over the last 1 week has left everyone a little stunned. It originated in the United States. So Sam Polyak, first question to you. How would you describe the 4.5% correction in a single day, or the 8% correction from recent highs? Is this just a letting off affair, or is this the start of a deeper correction?
It's a great question. I strongly believe that markets can't go straight up without any volatility for forever. And so what we've had over the last week or so is just kind of getting back to normalized levels. Stocks are still up a lot over the past year. I still see the prospects for equity markets and emerging markets in particular as being quite good for a fair amount of time. This correction is healthy. There's nothing that I see globally or in the U.S. that would make me think that fundamentals have changed that much in 1 week. So I wouldn't really worry about it, and if the correction continues, I'd see it as a pretty good buying opportunity.
Well, gentlemen, if you have any worries about the equity markets in the US, you're free to ask Sam or each other. But I just want to persist a little more, Sam. The questions about a little bit of correction is countered by people who say that valuations have never been so rich, that to get to even normal valuations, even a 25% fall will be par for the course, and only then we will come anywhere close to historical valuations. Is that right?
Well, it depends on how you look at valuations. A lot of people talk about the CAPE ratio, which normalizes margins. I believe the margins are higher and higher structurally. And so because of that, you have to look at multiples that are in the high teens, which are expensive. But at the same time, they're going to be getting a nice benefit, because the multinationals in the U.S. have a global book of business. And that book of business is much improved because of a recovery in places like India, and places like Brazil, places like Europe. So that's improving. You're getting that extra benefit from taxes that are coming down. So you're actually going to have earnings growth, accelerating earnings growth this year, which I think is part of the reason why the equity markets had done so well going into this correction. I don't believe those are going away. And so as part of that, I think overall the U.S. markets are very healthy. Global markets are healthy.
No, are you saying that historical valuation, 12-month trailing valuations may be unrealistic, but forward valuations in the U.S. are normal?
Correct. Because earnings growth is going to, in my opinion, is going to surprise to the upside.
Okay. Well, Navneet, you would be willingly tracking global markets as well. Is that the received wisdom for you from your sources and your own analysis, that 8%, maybe 10%, but the growth story is intact, and therefore the financial markets will be able to weather the storm?
So, of course, the global economy is seeing a synchronized growth momentum. Profit cycle has been pretty good. In fact, MSCI World, if I remember the number correctly, is likely to, the expected earnings growth this year is 14% on a high base. And my view is that corporate profits as a percentage of GDP are already at an all-time high. If the global economy, let's say even the real GDP, even if you add the inflation, and the corporate profits again are likely to grow at 14%, almost double the nominal GDP growth of the world, at some point in time that's likely to create some political trouble somewhere. Of course, the Trump's tax reforms, the regulatory reforms, which I believe will be followed by several other countries, will also make the picture look quite interesting and quite good for the year or two. But at some point in time, I think there should be some pressure on that, simply because you can't have an economy where the corporates are grabbing a larger and larger share of the pie. At some point in time, it's going to create a problem. And I think whether the fiscal policies or the political agenda may start shifting a little bit. So that's one of the concerns I have.
Inequality as a concern.
That we have been in a world which has been quite growth starved, which has been quite yield hungry. Now, if the yields go up, which are likely to, simply because we are seeing this inflation trade, inflation is going up. So far, it's been a great story. I mean, you had the growth coming back, but inflation not rearing its ugly head so far. But the initial signs are that the hourly wages, etc., have started rising. And at that point in time, if yields also start rising, then the relative attractiveness of most of the other asset classes also get impacted.
What are the chances, Sam, that inflation rises very quickly? At the moment, the markets are not even entirely factoring, the Fed fund futures or such other derivatives are not even entirely factoring in 3 rate hikes. There are people who are freely talking of 4 rate hikes. So will that be a source of instability?
Well, it depends on why rates are going up. I think the rates are going up because we have good prospects for growth. One of the biggest positives that I believe we've seen over the last 6 to 12 months is, for the first time since the global financial crisis, we genuinely see the output gap closing globally, not just in the U.S., but globally. The fact that you have wage hikes in the U.S. at the lower end of the income spectrum is actually quite good. It's good in terms of political stability. It's good in terms of consumption, which we haven't really had a broad-based consumption for quite a while.
So you don't agree with the inequality thesis so much? You think this is in fact a bottom of the pyramid growth?
I think right now it is. Whether it will sustain is another question, because you do have the structural issue of automation, which is impacting the bottom of the pyramid. But automation takes a while to play out. And so in the meantime, you really have the higher wages. Walmart's announced $10 minimum wage. You've had other companies go to 15, and so and states are looking to mandate that. So that should really help the lower income.
Okay. Well, the Ruchir Sharma thesis has been that the 4% growth is not possible because the labor force itself is shrunk. If you're going to compare it to the post-war baby boom generation, you had people then. Now you don't have that many people, so generating 4% is not going to be possible. You have any view on that?
I think it's a great point. I mean, this is one of the biggest positives for India, is because India has the demographic benefit that's coming through. U.S. had that benefit because of immigration. Okay. And I think because of that, we're not in the same position as countries like Italy or Germany or Japan, which have a shrinking population. Our population is not shrinking. We do have some structural headwinds, but I think they're being addressed, and we're adjusting to it.
All right. So Sam's thesis is very clear. I asked him repeatedly only to check out whether he sees headwinds to the U.S. growth, but no. Navneet, I think, is not that sure that global instability will not come our way.
No, I think this is like one of the best period you are living in last couple of years. The global growth momentum is pretty strong. I'm quite positive on capex cycle returning globally. I mean, capacities are hitting everywhere. I think shareholders are going to put a lot more pressure on corporates to stay away from the buybacks and dividends that they have done over the last few years, but to actually invest more in the new capacities and improving the productivity. So from that perspective, it's going to be good. But I just keep thinking from a very macro perspective, more from a political perspective, that if increasingly, which has been the case for last several years, even when the growth has been quite muted, a larger and larger pie has gone to the corporate sector, will it create some political challenge? And how it will ultimately unfold in what manner? So this is not a view on like next few quarters going to slow down. In fact, the corporate profits as a percentage of GDP based on this quarter and what's expected will hit an all-time high. It's like almost reaching 11% of GDP in US, substantially higher than long-term average. And it's, by the way, quite in contrast with India, where we are hitting the all-time low as a percentage of GDP. So something is really different about India.
Okay, we'll just come to the India. Since you brought it nicely to the Indian context, Manish, let me come to the Indian context. The US crash, pullback, coincided with the aftermath of the Indian budget. So what's your sense about the Indian market itself? You can make a very strong case that even the Indian markets were overvalued. So is this a start, therefore, of a slightly deeper correction here?
I think valuation is one part, but from a business cycle perspective, I'm more comfortable with the Indian economy rather than the US economy, because I think clearly US has more signs of late cycle than the Indian economy, because the Indian economy, along with most emerging markets, I think bottomed out in Feb 2016. And if we probably did not have GST, Demon, RERA, we probably would have had a much better growth year in 2017. But I think along with all emerging markets, we're going through a revival in growth, which is only 2 years old. US has been in a growth cycle for almost 9 years. It's one of the longest expansionary periods they've had. So from a business cycle perspective, which to my personal experience is more important than valuations, I'm more comfortable investing in Indian stock market than, I don't invest in US stock market, but if I were allowed, I would pick India over US at this point of time.